Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Sociedad, Química y Minera de Chile.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. And what we're seeing here is a really interesting dual narrative that you kind of have to peel back.
A dual narrative. How so?
Yeah, on one hand, you've got this company with really strong operational momentum, but on the other, it's still wrestling with these persistent sector-wide pricing pressures.
Okay, so a fight between their own execution and the macro environment. Let's unpack that. If we look at their recent performance, the Q3 2025 numbers, what do they actually tell us? I see they missed some expectations, but the market seems to be, well, rewarding them anyway.
That's where it gets really interesting. In Q3, revenue came in at $1.077 billion.
And that was a miss, right?
A slight miss, yeah. About 1.9% below the forecasts. But, and this is the key, if you look year over year, they actually grew revenue by a very healthy 8.9%.
So they had a strong quarter in a tough environment. But what about the bigger picture?
Right. So to maintain perspective, you have to look at the trailing 12 months, the TTM revenue, which is still down 9.24%.
Okay. So that TTM number reflects that broader weakness in lithium prices we've all been seeing.
Exactly. It tells us that while they had one good quarter, that overall commodity price is still a major headwind.
So the top line is improving despite those headwinds. Where's that strength coming from then?
It's almost all coming from volume, just sheer volume.
Really?
Yeah, they achieved record lithium sales volumes in Q3, and that shows their operational engine is just running incredibly efficiently. They're grabbing market share.
And I assume their other segments are helping with the margins.
They are. I mean, while lithium gets all the headlines, their profit margins are still solid. Gross margin is 27.6% TTM, and operating margin is sitting at 21.2%.
That's pretty strong.
It is, and it's significantly helped by their specialty plant nutrition and iodine segments. They provide a much-needed buffer.
And the market is clearly noticing this operational strength. I mean, we saw the stock hit new 52-week highs.
Right. It reached around $75. That's a strong bullish breakout, above those old resistance levels.
And it wasn't on low volume either.
Not at all. The surge had increased trading volume behind it, which shows robust investor confidence. It's not just a technical bounce, capital's flowing in.
Okay, so let's move beyond the quarterly numbers. A real long-term investment isn't just about one quarter, it's about their structural advantage. What's their core competitive moat?
Their primary moat is cost leadership, period.
And that comes from where they operate.
Exactly. The Atacama salt flat in Chile. It's one of the world's lowest cost lithium brine deposits. This location allows them to produce lithium at costs roughly 30% lower than their hard rock competitors.
30%? Wow. That's a massive buffer.
It's a huge buffer. When lithium prices drop, they're still profitable while others are, just trying to break even. It protects their market share.
That's like they own the wheat farm while everyone else is buying flour at market prices.
That's a great way to put it. And it's why they still hold over 40% of the global lithium market. They also have scale advantages in direct lithium extraction technology.
DLE, right? How critical is that for them?
It's a game changer. It means they can process brine faster using way less water, so it's better for efficiency, speed, and crucially for the environment, which helps them keep their license to operate.
So cost, technology, that's the foundation. But this is where it gets really interesting, right? Tell us about the big partnership. I heard something about Codelco.
This is maybe the single most important catalyst for the long term. They formed a joint venture called Nova Andino Litio with Codelco, Chile's massive state-owned mining company.
And this is huge because it secures their access to the reserves for decades, isn't it?
Decades. It essentially secures their access to those Atacama reserves well into the 2060s. Before this deal, there was a lot more uncertainty.
So it de-risks their operational tenure.
It does. But you raise a good point. Doesn't teaming up with a state entity add a new layer of, say, political risk?
Exactly. Investors usually get nervous with more government involvement.
And that's the trade-off. But the market sees it as a net positive because it buys them decades of access to the world's cheapest lithium. That's an advantage competitors just can't replicate.
Okay, so strategically they seem set. What about their balance sheet? Can they actually fund all this expansion?
Financially, the company looks exceptionally stable. Liquidity is strong. Their current ratio is 2.8.
Meaning they have almost $3 in assets for every $1 of short-term debt.
Precisely. And their quick ratio is 1.7. They're sitting on 2.39 billion in cash. They have the muscle to execute.
And they're still returning value to shareholders. I saw a special dividend was paid out.
He did, yeah. A special dividend of about 12 cents per share in December.
It sounds fantastic, but what's the counter-argument? What risks should a potential investor be aware of?
This raises an important question, especially with the stock at a high. The primary risk, as we touched on, is still lithium price volatility. Their operations are strong, but the price environment dictates their top line.
And what about their debt? You mentioned they have the cash, but 4.65 billion in total debt is not a small number.
It's not, and this is where you have to look at the sensitivities. Their net debt to EBITDA is a manageable 1.8 times. However,
There's always a however.
the company saw a sharp 22% decline in EBIT last year.
So with that decline and high interest rates, how manageable is that debt really? If lithium prices stay low, that could become a real problem, couldn't it?
That is the critical sensitivity the market is weighing right now. The debt is manageable if the recovery happens on schedule. If it doesn't, that debt turns from a hurdle into a major headwind.
And how are the analysts viewing this whole balancing act?
There's a notable divide, a real split in perception. On one side, you have analysts raising their price target up to $90, betting on the Codelco deal.
And the other side?
The other side is much more skeptical, with targets down around $47. They're worried about how quickly prices will actually recover.
And this is all reflected in the valuation, I imagine.
It is. The stock trades at an elevated price-to-free cash flow ratio of 312.
Whoa, 312, that's astronomical.
It is. The market is pricing in massive future growth to justify that multiple. It's a high-conviction, high-risk momentum play.
So let's bring this home. What should listeners be watching for in the immediate future? What are the key dates?
The next big one is the Q4 2025 earnings release. It's expected around February 26, 2026.
And that'll be a critical test.
A huge test. Consensus is forecasting net sales jumping to $1.2 billion and EPS climbing to 78 cents. That would be a big recovery from Q3's 62 cents.
And operationally, beyond the numbers.
Keep a close eye on any updates about the Nova Andino Litio ramp-up in the first quarter of 2026. Any positive news confirming expanded output will be a major driver for the stock.
And then there are the macro tailwinds, like EV demand and potential rate cuts.
Exactly. Those are tailwinds for all commodity producers, and SQM is perfectly positioned to benefit from them.
That's a comprehensive look at a company sitting right at that intersection of cost control, future potential, and some pretty high valuation risk.
If you connect it all to the bigger picture, the core investment thesis is a multi-year hold. You're betting their cost moat, and the Codelco partnership will let them dominate the volume surge that's coming.
And the stock's current high suggests that momentum is already there.
It is, which means the margin for error is razor thin. It's a high-stakes wager on the energy transition.
Great insights as always. If you enjoyed our conversation today and want more deep dives into the market, please subscribe, like, and comment below to support Smart Wealth with Joshua.